All right, everybody. Happy days, happy days. Let's do let's do a video on market structure right quick. I'm gonna try to give as many examples as I can for you to understand. But let's try to draw some things first. So go down a bit down here and get a blank screen. All right, so so the very first thing that we should talk about is what happens in the market, right? There's three things that happen in the market. First thing is we go up. You know what? Let's leave it at we go up. This is scenario one. All right. Scenario two is we consolidate. Consolidation just means we go up and down, up and down, and up and down, meaning that we trade in a range, and this range is often pretty consistent, and you can kind of expect it to hit about the same range often. All right, so that's scenario two. I'm going to delete those lines. And this is sideways. Okay, so you got two scenarios, and the third scenario, as you might guess, is we go down. So, down. Okay, so these are the three scenarios of what the market does. And my goal is to make it as simple as possible to understand, because I think simplicity makes things so much easier. And that's also how my brain works. So if we know there are three things that can happen, that does simplify a lot of what we can think about when we're looking at the charts, what we're thinking about as far as what it's going to do, what it might do. Sometimes I feel like as traders, we try to give ourselves a lot of what if scenarios in our head and we overthink. And I'm not saying that this makes trading easy either, but I think if you can simplify things, it makes things a little bit better. All right, so that's the first thing I want to say, is the market does three things. The second thing that I wanted to say is that the market, regardless of what direction that it goes in, can retraces. Okay, so retracement literally just means the little pullbacks that we see on the way to the direction that it wants to go in, right? So this right here, let's say, is going up in the first time, and so it retraces back down, and then it goes up and then it retraces, or you could see it vice versa, depending on when the move starts in the consolidation. The retracement just would mean a quick break before the move continues to go in the direction that it wanted to go into, right? And why something wants to go in a certain direction, that's another conversation, and we'll talk about that later. But for the sake of this conversation, there is directional movement, and there is retracement, and then there is consolidation, where price just goes up and down, up and down, up and down between 2 points of prices, 2 price points. It's a better English. Okay, all right, so what we want to do is, regardless of which direction it's going into, ideally we want to trade directionally. You can still trade consolidations, And I'm calling this sideways, but slash consolidation. Let's update that. It's easier to trade directionally, I think. Consolidation is a little bit trickier, but I do think it's tradable. It's just way harder because you never know when it's going to go either up fully or down fully. And sometimes they do both to take away people's positions so that they can use that as liquidity. That's also another conversation. So what we want to do as traders is every time that, now let's go to the directional conversation. So let's talk about going up for now, and then we're going to do the opposite later. So if you're trying to go up, if the market is going up and you just want to make money from it going up, what you might want to do, God, what you might want to do is a couple of things. You can do anything you want. You can buy here. 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 And you can buy here. Those are some obvious choices of what you can do. Some of them look more riskier, and some of them look less riskier. And that's really what I guess it comes down to, right? So if you choose to buy at the bottom, that's probably the least riskiest trade. But then the next question becomes, how do you even know what the bottom is? Right? Like, how would you know that that is the bottom and that the price is not going to go any lower, and that anything that happens from this point forward, you're always going to be in profit? How would you know that? I personally really wouldn't know how. I think I would need some sort of confirmation, right? And so in this scenario, you're kind of guessing, gambling, right? Because you don't know. You're kind of guessing if this is a low or not. And let's assume that you don't even have any proper information from previous price action. You're kind of just saying, this is the low. The price is only going to go up from here. And so I'm going to buy right here. You have no confirmation. You have no, like, it's like a theory and a hypothesis, and you're going to go test it. But you don't have like some indicators and or some sort of like conviction. And you might, if you're gambling, just because, you know, one of two things is going to happen anyways. But if you're going to trade, you need to have probability on your side, right? And so right now in this scenario, if you were to take a trade here, you have no idea of risk, probably, because then where would you put your stop? That's really what this comes down to, right? That's really the main issue with this entry, is you could be right and you could make the most money because you are going up. If you are right, the price is going up. Let's say that you did buy right here and the price never retraced any lower and it just went up for the rest of the day. You would be pretty lucky and you would be right. That's true. But you then would not have any idea of where your stop loss would be. So if you bought right here and put a buy, you know, where would your, let's move this right here. Where would your stop loss be? Like, it can keep going. You know what I'm saying? There's nothing here that says your stop loss should be here. And you can, let's just say, arbitrarily say, you have like a mechanical predefined risk, let's say your risk is always 3 to 1, right? So let's say you got in right here, you put, you know, 1 R of risk and then 3 R's of reward. And somehow you're right and it ends up working out. This could work, that's true. It just wouldn't be a more, I wouldn't say advanced because advanced is misleading. It just isn't as accurate as it could be. Because right now, right here, you know, it could decide, price could, if you had not known this was going to happen, price could have just decided to go down, hit your stop, and then continue to go up. That could also be a thing, right? So your goal is to eventually find an entry that makes sense, find an entry that has low risk, and the third thing is find an entry that has high probability. Probability. I think that's right. Okay. So the three things that you have to think of when it comes to this type of an entry is these are kind of undefined and very ambiguous, and you're kind of in no man's land. Okay, so that's scenario 1. Let's delete this. Let's delete that. Let's delete that. Let's delete that. Okay, scenario 2 is if you decide to buy up here. If you decide to buy up here, so let's say for whatever reason, price has not gone down and consolidated and you're not buying here. Let's say you're buying right here. This is kind of an obvious silly one because this would mean that you are chasing price. FOMO, right? You don't really wait for the price to come down and retrace at least a portion of the distance that it went up or down. You're just like, you know what? It's gone up so far. I don't want to miss out on this move. And so you decide to get in at the top. And what does it do? As usual, it ends up retracing down, sometimes small, sometimes bigger, sometimes very close to the origin of the move, or even lower, right? A lot of things can happen. Very close, deep, middle, very deep, or lower before it goes into the direction you expect it to go. But let's say that it just goes back to the 50%, right? If you bought here, you wouldn't know where to put your stop. Like this is obviously like a very, very risky trade, which is why a lot of people say try to be patient and wait for your setup and try to avoid FOMO or chasing price and things like that, because you just don't know where you would put your risk. And when I say your risk, it means your stop loss. Like at what point, if the price reverses on you, are you going to decide, okay, this is not the right trade for me, and cut it and call it a day and take your loss and move on to the next trade, right? So this is just, I mean, you can make an assumption and say maybe 50%, but like I said again, what if price does this? Maybe it doesn't take out the low, but it gets really close to it. What about that? Then you get taken out and it still goes in the direction of your trade. Now you're not only going to be mad that you took a loss, but you're also going to be mad that you were right. You know what I mean? Like, tough, very, very tough. So, 2 reasons that you probably wouldn't take this: very risky, and probably the most emotional too. Kind of a trade that you could take of all the scenarios that we talked about, or that we're going to talk about, is this one. So I would avoid this kind of trading. It's just not good. It's never good. Sometimes you get really lucky where price, let's say you had gotten in, let's say here, and at that time you were looking at it, it was still the high because you hadn't seen the price to the right, right? But you still got in and you got lucky that it kept going up and maybe you got out close to here, but maybe you didn't wait and hold on long enough to see it retrace and go lower than your entry, either very far or even a little bit, because seeing yourself get into profit and then eventually watching your profits disappear, you're probably gonna get out right below your profits go red, right after your profits go red, because you're gonna be scared that this could happen, right? So blindly getting into a moving price sometimes can work, but it's not safe and it's gonna make you more emotional, right? And it's gonna be really hard for you to mechanically actually define your risk because you don't know where that would be. All right, so that's that. That is scenario 2. Let's go on to scenario 3. Scenario 3 is you getting in right here. So you've seen so far that price has decided to go up, and after going up, it has decided to retrace a little bit and take a break. And now you're wondering if this break is going to continue to take you higher, or if it's gonna go, oops, or if this break is, God, or if this break is gonna go lower and go below this low, right? But right now you're just right here and you're seeing things. So the first thing that tells you that this price may go up is you have proof, right? You have, it's right there. It happened, right? It already moved up. So you're not guessing, you're just looking at what happened. It has already moved up. And so your idea of looking at something and seeing it for what it is, as opposed to for seeing it for you want it to be in your mind, is going to be really the difference between how you see what happens and what doesn't happen. So right now, as we're looking at this right here, we saw it go from down here to up here, and it has decided to come down to about 50%. And so far we do have concrete proof that price is willing to go higher than the current price that we're at. So the next question we're asking ourselves is it worth it for us to figure out how to get in here to go to see if we would be willing to create a lower high than the previous high that we created? So anything above this, right? And what happens is things happen right here that, oh, not that one. Where's the circle one? I can't find the circle one, but let's just do, that's not gonna work either. Too bad. All right. Something happens at this point that gives us a higher probability and likelihood. Right? And then, of course, the last thing is defined risk. Okay, so when you're right here, first thing that we talked about is you have proof that price is willing to go higher than the current place that you're at. The second thing is, because of that reason, that you have a higher probability that price is willing to go higher than that, because it has already going higher than this one, right? So even if it doesn't go as high as this, what is the probability that price is willing to go higher than the current place that you're at, right? Not necessarily higher than the top, but what about this range in between? Is it willing to go in between it, no matter how far? That's the next question, right? And you have a higher probability because it's done it before. And then the second thing is, if you were to get in right here and put a stop right below it, right, aiming for the top here, is your risk to reward in your favor for you to be profitable and consistent in the long term, right? Is your risk defined, and are you going to be willing to accept it and let the trade do what it's going to do anyways, right? So one of the things that happens when you are trading is that you will say that I want to take a trade and I'm willing to go for $20 profit and I'm willing to lose $10 in order to find out if I can get profit. What happens is, let's say the trade starts to go against you and you start to like panic, you start to get nervous, your emotions start to take over. And then you don't know if you still have the same level of conviction because of your emotions. And so you start to self doubt. And you start getting closer to 10, you start going to -4, -5, -6, -7, -4, back to -6, -7, -8, back to -5, back to -4, -3, -5, -7. And meanwhile, you're kind of just, all over the place. Your emotions are getting wrecked. You're not accepting that you're willing to take the $10 loss. Even though in this example, $10 is considered small, right? And it may not be small to everybody else, but relatively speaking, your emotions can still get you to lie to yourself that you're accepting the risk, but you really don't accept it until you start to see that the price coming against you, right? And so what accepting a risk means is that you put on the trade, you put the entry, you put the stop loss, and you put your target, and you can walk away from your computer and still live your life without thinking about the trade in the back of your mind and things like that. That's what that would mean to accept the risk. So for you to feel that level of confidence and peace in the kind of trades that you're taking, you have to position yourself in places where you can say, if it goes below this area, you know what, whatever, I'm just going to the next trade. Imagine if you're just trading right here, which was the previous scenario that we were talking about. Look at the amount of risk that would just wreck you, right? There's literally, if you said this is my risk, then would that mean that your reward would have to be so much higher? Then when you start asking for insane risk to reward ratios, you become really unrealistic about what you can trade and how the market moves. And you're often dreaming about things that usually don't happen in the market. They happen once in a while, but not realistic for being a profitable, consistent trader that is, looking to come in every day, trying to create consistent results. So this example right here gives you a level of peace that whatever your strategy is that over time, the amount of reward that you're making for the amount of risk that you're taking over time, if you're right, even 50% of the time, your strategy is going to be profitable over time. What this allows you to eventually do is to trust yourself, to trust your process, to trust your system, and to just do it, to just execute. When you see it, you just do it, you don't think about it, and then you let the numbers do what the numbers do. Okay, so now let's just review what we just talked about. That was scenario 3. Right, and then the other scenarios that I showed earlier are just repeating patterns of these 3 scenarios, right? Finding the bottom, buying the very top, right? Finding the bottom is almost impossible, so don't even try. You're probably lucky if you do. Finding the top is really easy to do because of the feeling of missing out. And you can be surprised how strong that emotion is when it comes to trading, especially money. And so these 2 things are almost unrealistic, and they're kind of very far apart in the spectrum of maybe how you should be looking at trading, right? They're very like my worthy highway kind of trading. You know what I'm saying? So it's almost like you're expecting every trade to work out kind of trading, because there's no probability thinking, there's no risk thinking, and you're not factoring in how you would emotionally feel if the trade went against you, right? Those are scenario 1 and 2. Scenario 3 says that, well, price has gone up in the direction, right? Because if you're getting in here, your bias is to go up, right? And so if your bias is to go up, it's much easier to believe that it can go up if it has done it before, right? That's just, again, proof. That's what I mentioned earlier. You can call it whatever else you want to call it. It's easier to believe in something you've already seen before. That's one thing, to have conviction. And then the second thing is that risk is that once you get in this area, you can reduce. Some people try to trade and their risk is like this, and they go for this, and it almost looks like a 1-to-1, or they go higher, which just means that they reduce the amount of things that they trade. Like, so if they were trading like $1,000 worth of contracts, maybe they reduce it to $200 worth of contracts because the risk has gone bigger. But if you're trading like this, then you can have not a large size, but even a decent amount of size, and still predefine your risk while expecting the things that you're expecting. Okay, so that's just a conversation on how you should think about trading, just generally speaking, without really trying to complicate it too much, right? Like, would you want to buy at the top? Would you want to buy at the bottom? Or would you want to buy in the middle? The middle is the way. All right, the Buddha said it, and it is so. Now that we've talked about that, now let's talk about the details of what about the middle that we're looking to aim for, right? Now let's create another one. No, actually, I'm going to explain the middle a little bit better. Okay. Okay, so now what we want to do, now that we have accepted the middle way, right, as a philosophy, now we want to give ourselves even more confirmation that it makes sense to do what we're about to do, right? One is, anytime we trade, we're probably gonna have a higher probability of being right, and we're also gonna have low risk, right? So let me just write those two down. High probability, low risk. That's what the case is for trying to wait for a retracement. Now, let's talk about confirmation. Confirmation is like the idea of, I have this idea, and the probability of it right now is, let's say, at a 50%. And I would like to do as much as I can to increase that probability in my mind closer to 70 to 80%, so that I can have more winning trades, less losers, and more profits. Okay, so on top of high probability and low risk, you want to increase confirmation. You're gonna identify a confirmation so that you can have, let me borrow that, higher probability, and then lower risk. But you're pretty much taking the same idea, but refining it a little bit more so that your edge gets sharper. That's the idea. Okay, so with that being said, how do you actually create a sharper edge? Well, you're looking for an entry in the middle of a range. And what is a range? A range is the low and the high, right? From this area to this area, we call that a range. From this area to this area, we call that a range. From this area to this area, we call that a range. And so what are each of these points that reverse and create kind of like a high or a low? These things are called swing points. Say it with me, swing points. Okay. What you want to do is you want to use swing points to your advantage to create higher probability and lower risk. So you have a swing point right here, and you have a swing point right here. So this swing point right now, you also have a swing point right here. This swing point right here takes the low, comes down to this area, creates a swing point by taking out the high. So how are actual swing points even created? Swing points are created when something happens in the future, right? They don't always exist until something happens in the future that defines them. So what do I mean by that? So this swing point is not yet created until the move down takes out the low that created it, right? I don't know if that makes sense, but you're gonna have to kind of visually see it and just sit in it, right? This low goes up. This is not yet a swing point yet. And then once it comes down and takes out the low, when I say takes out, it means to go below or go above a certain price level. So if it takes out this low, then eventually this gets defined as a swing high. Why? Because this point right here is higher than this area. And so now it has been defined as a swing high. Now, when we go here, we create this low. It is not yet defined as a swing low yet. What does define it is if we go past the previous swing point that created it and that defined it. And so what, in the same fashion, we need to let it go up and take out this high. That means go higher than that price, so that this then eventually becomes defined as a swing point, right? Same fashion in here. You go up, this point right here is a high. It's not yet a swing high until it goes down until a certain point where some low gets taken out. Now, this scenario is different, right? Because we're not taking out a low yet like this. So when does it actually become defined as a swing high? Well, when this swing right here takes out the high, then it ends up becoming a swing high, and then this becomes a swing low, right? I know that can sound a little confusing, but this is a swing high as soon as this has taken it out, right? But even more so when this swing low has been created and takes out this high. Again, that sounds confusing, but it'll start to make sense as you kind of start to see it more and more. And maybe I'll find better ways to define it. But again, the kind of idea that I want you to think of to simplify it and not make it even more complicated than what it is the peaks and valleys are called swing points. So let's just call it that. Peaks and valleys of price action are called swing points. So what you want to do, going back to the idea of how you get a higher probability and risk, is you want to look for a change in price delivery, right? So what do I mean by that? Right now, price just went down, but it decided to go above this swing high. And if the price closes above the swing high, then for you to start anticipating for price to come down into the 50% of this range becomes a realistic idea, like a realistic trade idea or plan, right? If it closes above this swing to the opposite direction like that and closes above it, you can start to expect it to come back down either to the 50%, 30%, or the 70% of the range in order to get the most discount you can get, which means lower risk, and the higher probability that you're going to get that your trade is going to give you the move that you're looking for, right? So for me, I usually look for between 50 and 70. If I can see something go into the 70, typically what I see is the reaction is a little bit more quick in the direction of the move that I want it to go into. If it's in the 50, sometimes what it might do, or even the 30, what it might do is like bounce a little bit and go down to 50 or 70 and then bounce eventually. So what I want to do is I don't want to get that initial bounce that is going to fake me out. I want to get that deep retracement and that deep discount that is eventually going to reject me out of this area and go back up and create a new swing high by taking out the previous swing high. Okay, so your goal again is to get in the middle of a move. And in order to get in the middle of the move, what you're looking for is you're looking for a previous swing high that got taken out by the move that went higher that you're expecting to retrace, and see what it looked like for the move to go above it. Was it strong? Was it weak? Was it a wick, or was it a full body candle? And if it's a full body candle, that is the only scenario in which you would start considering that this range may be something that you might want to play to the top side, because again, it's giving you proof that we have gone above the previous swing high. And so the likelihood of continuing to get and create a new swing high is there. You're just trying to figure out at what point does it make sense for you to take that risk, because again, your goal is to protect your money, not necessarily make money, because you will make money, you just have to protect it, right? Sounds pretty simple, I know, but that's the idea. So I'm gonna say it one more time so it clicks. What you're looking for is a swing high. If you're buying, for this example, we're buying, right? We're buyers. You're looking for a swing high to be taken out aggressively and with real strength. And you will know what that means when you see candles. And you're looking for a full body closure above the swing high. And I'll show you examples of what that looks like in a second. Once you see that, then eventually, after it finds a stop and decides to start reversing, you're looking for a full body swing lower into this range. And the range that you're looking to calculate is the range of the swing high that you took out and the low that the move originated from in the first place, right? Because then you would say, from the available range that we had, we took it out. And so now there's probably some orders in here of people who were trying to get filled to go higher that probably got left behind. And so what it's going to look to do, it's going to come back and see if it can fill the rest of those orders and then go back up into the intended direction. But you also have to remember that price can't just go up all the way and price can't just go down all the way, because there needs to be a buyer for a seller and there needs to be a seller for a buyer, right? You have to always remember that. So it's always going to go up and down, up and down, up and down, or down, up, down, up, down, up, down, up in the opposite direction. Okay, so you have to imagine the opposite for sellers. So I'm going to just do this quickly for the opposite. So you can expect, right, the same kind of deal, right? So this swing high gets taken out with this move down. And so what we're expecting to do is we're trying to see what this range is looking like, spread it out to the right, so that when the price starts to retrace back into discount for us to give us a chance, then we're aiming for 50 to 70% of the discount area so that we can get a lot of discount to continue going short. Eventually what we want to do is we want to put our order right here, reduce the risk to that, and then aim for this low. And for the buyers, same thing. Reduce the risk. Let me actually bring this down to the 70 because that's when it's really great. And then aim for that high. Okay, so this is something you're gonna have to probably see like a few times for it to make sense, but I'm gonna show you some examples in a second. So just trust that your eyes are gonna eventually start to see these swing points. If you can start seeing swing points getting taken out to the top side or to the lower side, that should start triggering your mind that there's it's time to start tracing the range that it just broke down so that I can see if it retraces back into the range, then I would get probably the most discount I possibly can get, and I can have higher conviction and a higher probability and the lowest risk to aim for the last low that it created, because the fact that it created this low, there's a possibility that it can create a lower low, right? That's the idea that's going through your mind when you're thinking of this. And when it comes to the buyers, you're pretty much saying the same thing, right? Like price has already gone higher, and so I'm just expecting for price to come back down so I can get a discount and eventually try to see if price is willing to go higher than the previous high that it's made, or at least get closer to the previous high that it's made, because I've already seen that it has been able to do that, right? So lower risk, higher probability, and the confirmation specifically is how it closes above a swing high or a swing low. And I'm going to tell you what the difference is, because there's weak confirmation and there's good confirmation. And so let's go to examples. Hopefully this is clear. Moving on to the chart. Guys, I'm going to delete all of this, so yeah. All right. Let's go to the 5 minute. Okay. All right. Let's look for obvious swing points. Ba-bum. La 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 la. Okay, so with candles it gets a little tricky, but with more practice I think you can see it. Okay, I see a swing right here that gets taken out. So we come from down here, we go to up here, we go to down here, we go and do that, right? So we took out this swing high right here, but we never really mitigated it well until the 50%, until this candle right here. This candle perfectly does it, right? And so what you want to do is you want to look at that range, put your fib retracement thing, and just do that. Draw it to the right. Once you do that, it's going to show you where the 30%, 50%, and 70% retracement places are. Your goal, again, is to aim for 50 and 70. 30% is not amazing. And you want to let it first retrace and bounce. And then off of the bounce, you want to look for a similar thing in the area that it just bounced off of. So the first thing that has caught our attention is that it has come to the 50%. So if we just kept it that simple, right? Let's say it was just that simple, and your goal was to just buy it off the 50% regardless of what happens. It can just be that simple. What you would do is you would use your buying thing. Let's say you put, let's say your stop, you're aiming for the high that was previously just put, and your stop is going to be the bottom of the range, let's say, for this example. And it does take a while, but you get there, and it's a great trade, right? Now, the question is, even with this trade being a great successful trade, would you be able to hold the trade through this drawdown, right? Because it does go up, but it comes back down pretty close to your entry. And that's even if you got in at the bottom of the bottom, right? But let's say you did. Would you be able to wait for this retracement to come down to your entry before it just goes straight back up into your target, right? That question is really about refining your entry. And so what I was saying earlier about first identifying the range and seeing where that's at. Now I know that the 50% is right here. So I'm just going to get rid of this, since this triangle widget also defines the 50%, right? I'm going to do it again on the swing that just got created right then and there too, like the small swing. So hard to do. Okay, so then we are looking at the bigger swing, and it comes down to the bigger swings 50%, and then this little swing right here gets taken out, and then it comes back down and retraces to it. Look at that, it retraces between the 50 and 70. Now imagine if you got in right here. Let's say this 50 was the one you saw, and you put your stop right there. Look at the RR, it just changes dramatically with how clean your trade is. One, you don't experience any drawdown, but two, your stop loss just got smaller and your RR just got higher. And so what I'm saying by that is that idea of inception is that if I can find the circle shape, I don't know if I'll find the circle shape. Oh, here it is. Here's the circle shape. Okay. So if you've watched the movie Inception, it's about this idea where reality kind of repeats in the same fragmented way over and over. And you keep seeing the same thing over and over as you get closer, get deeper into the circle, right? And it just keeps on going. You move deeper into the circle, and each circle that you get inside of is just the same circle all over again, right? And so when you're trading in a higher time frame, you might be on one of these outside circles. But when you get closer to a smaller time frame swing like this one, you're getting closer to the smaller inner circles. And when you do that, you are literally seeing the same thing. It's not any different. You would apply the same principles you just applied to a higher candle at a higher time frame. And then what that does is it gives you precision. That's pretty much what it does. It makes your edge so sharp that you don't have to deal with drawdown in your trades as often, and the risk that you take for each of your trades just gets smaller and smaller. And so you don't even need 50% of your trades to be right in this kind of a trading environment. You could have 40% be right, and you can have 60% of your trades be losers, which, by the way, this avoids. But let's say if you did, right, you would still be a profitable and consistent trader with this method, because you would identify the area, you would go deeper into that area and find an even better place. You identify that area even more and highlight that, and within that you find an even better place and you highlight that, and then you take a trade. That's essentially what this is, right? So this would have been a really great trade with this idea, right? So I'm gonna go ahead, take a screenshot of that, call that a day, and let's move on to another example. Oops. Another example. Looking for cleaner ones. I do see some, but they're not very clean. Especially prior to FOMC. Okay. Oh, look at this one. This one is spicy. Spicy meatballs. Oh, is it spicy meatball or spicy meatballs? Whichever one. Okay. So I see there's a bunch of swings in here that I see, but I specifically see this swing right here. And then it comes back down here and then it goes up. Do you see that? It's a little not obvious, but it's there. And it's very close to you know, if I were to clean this up and make it ideal, it's exactly the kind of move that you would expect when you're going up, right? Down, up, down, up, down, up. Okay, so now that we have that as an idea, let's look at the swing high that we're expecting to be taken out. That swing high is the area that we're expecting to take out. Once that gets taken out by this green candle, that confirms that this low right here has then become the swing low. So swing high, swing low, and as soon as we take it out with force, and with force, what does with force mean? It just means that the candles that are going in the direction that you want to take out, like a specific swing, are full body candles as opposed to wicks. Like this is called a wick. This is a full body candle. Full body candle just says that there's more people that are convinced that this is the direction that they want to go into. Whereas a wick, you know, people can make a guess that they want to go this way, but then the guys that are actually sure which way they want to go eventually buy it all the way up and change everybody's direction. Okay, so this is one of those traits that I mentioned where sometimes when the momentum is so strong and the algorithm is on for real, that you may not get the kind of retracement that you want. Like for me, I like retracements between 50 to 70%. But when you have momentum that is very aggressive and it's only like it's not taking prisoners kind of aggressive, right? What it will do is it will get closer to the 30%, but it won't go much deeper like to the 70% oftentimes, right? Especially if when it creates a swing, it creates a low like this, right? Because if we look at the first swing that was created, right? It was actually this swing. This was the actual swing. But they went and took the low so that they can get more liquidity. And when things like this happen where they take out even more, as opposed to like, you know, going halfway and going back up, it's decided to go back even lower and take out the low, which means that the move from this area is going to probably be more aggressive and it's probably not going to get you a 70% retracement, but probably closer to 30 or 50 or even higher than that. So with that being said, let me delete that. Let me go back to the retracement that I had drawn. It gets closer to the 30%, and what you would do is you would get in closer. You would get in closer to that, and if it's aggressive, you can aim higher for your targets. Right? You have a swing high, it gets aggressively taken out. You get a candle. It can be a swing. It can be a, what do you call it? A wick, candle wick, or it can be a body full candle that comes down into your retracement area, and then it just goes up into the intended direction. Okay, so this one is a different example. It's not exactly the clean example that I mentioned previously. This is an example of a move that happens and is a little bit more aggressive because a new low has been put in. And so this is a concept that will get clear in the future. I don't want to really go too deep into it. I just want to go and show you how it retraced after taking the swing high, just for the sake of that example. But if you really wanted to see how this move even happened in the first place, you can look at this swing. It's only one candle, but it does happen. So look at the swing. It gets taken out by this strong candle. So now, in previous examples, I had shown you where swings are created with multiple candles, like they are formed after multiple candles have existed. But in this case right here, it's only one candle that has been completely taken out by another candle. But remember, anything that happens at a higher time frame is also happening at a lower time frame. So you can imagine there's a bunch of candles that are happening within this 5-minute candle. right? So going back to that inception idea. So this candle gets taken out, and so we're expecting something to come back into the 50%. And what do you see? Right? Straight to the 50. You can put your order in the 50. You can put your stop right there. And you can just go crazy. And that just increased the RR from 5 to 11. You see that? The risk to reward just got even better. And so with this example, the range that I was showing you was a little bit bigger. But if you really go into why it even came back, it's because in the originally when the move found its swing, it bounced. And so you have to look for the origin of the move before it went up, so you can start considering where it might come back down to give you the biggest discount. Right? So we started seeing it turn around at 760, which is the red, right? And then it bounced all the way up to 807. And so in here, where did we see the biggest swing occur? Right here with this candle, because you can see how big that candle is, how ferocious it came in, and it's mostly a full body candle as opposed to a wick, right? And how did it close above this wick? Very, very strong, right? And so then you're thinking to yourself, well, if there is a swing in here at the lower time frame that just got taken out but hasn't gotten back and addressed, then there's a possibility that it may come back down. And so you draw out your percentages, the 30 to 50 and the 70. And wow, it's kind of perfect. The 50 is perfect. And again, look at that risk. You would risk 6 points to make 70 points. You know, it only has to be a few of these trades that hit for you to be a profitable trader. Like I said, you don't have to have 50% winning ratio in order to be a good trader with these examples that I'm showing right now. So I'm going to take another screenshot of this one so we can share that as a resource. All right, moving on to another example. Well, this is a bit of a messy example, but it is a good example. It's right there. So we have a swing right here. And it gets taken out right here first with this candle. But this candle doesn't close below it. And what I mean by close, like I mentioned earlier, is the body is not below the low of that candle. So that means it's not a good confirmation. This is a weak confirmation until 3 candles later, in which we get a decent confirmation that goes below that and it closes with a full body, right? And so what does that mean? That makes it a decent swing. So what we're seeing is this right now. This is the swing we're seeing, and then, oops, I think I messed that up. What we're seeing is this right here, to go here, to go here, to go here, and then lower, as far down as you want, right? Depending on what's happening to the left of the chart. So hopefully, if we bring this out, this is very similar, isn't it, to the examples that we just talked about earlier, where, right, if we were to clean it up a little bit, right, obviously price action is not going to be perfect, but it's very similar to what we had talked about as an example, where we have a swing low, we have a swing high, takes the low, then this becomes a swing high, and then we go back up, right, and then we go back down, this becomes another swing low. That's the example right there. It falls under our criteria, right? So what do we do when we see that? We create our measurement. So as soon as this black candle closes and confirms that this becomes a swing low and this becomes a swing high, what we want to see is another candle that goes up into the range, up until the 50 to 70%. And again, with this example, you get the 50% to the short side, right? And right? Let's say you went here and your stop was at the end of the range, right? If look at the move right here, bro. Look at the move. I mean, this is you can go lower if you wanted, but let's say I aimed for the low in the fair value gap right here. That in itself would have been a good trade, which would have been a 5R. If you had gone a little bit deeper into here, that would have been a 7R. If you'd have gone a little bit deeper, that would have been a 9R, almost a 10 bagger, right? And so you don't need all of that. You just need a decent amount. If I went into the 50% of this fair value gap, that would have still been decent, right? A 6R. But the same idea applies, right? You have a swing low, swing high, gets taken out. And then what we want to do is we want to go back inside the range of the swing that we just broke down. And we want to see if we can get 50%. If we can, then we aim for a swing low that is on the left side of here if we're going short. And then we put a low, let that cook. Okay. So that's another example of a great trade. I think that you get another chance, it seems, right here to get in. If you didn't get in the first time around, you get in another chance. You can go lower again. Let me get this closer to here so you can see the numbers even better. And that there is your third example. I don't know, is that the third or fourth example? No, I'm kind of getting lost. I think that was the fourth example. I'm gonna download that. Or was that the third? I don't remember. I've gotten lost. But hopefully that helps. Again, you know, the point is I'm going to review, you know, the things that we've talked about, right? You know, a couple of things can happen in price action, up or down. Consolidation. Or we can have down. And your goal is in whatever direction it's intending to go, you first have to let it do it, right? Show you proof that it's willing to do it. Then you need to wait for it to come back closer to where it started to make the move that it showed you that it's willing to make. And then look for a percentage ratio of up to 50 to 70% discount, and then try to get in there and aim for the previous high or low that it just made. That is your goal. And as you get better and refine this idea and strategy, your goal is to go into the area that it's stopping at again and look for another swing that gets taken out and look for that 50 to 70% discount. So you're kind of creating this refinement across time frames. And so what I mean by time frames is you have the hourly candles, you have the 15-minute candles, 5-minute candles, 1-minute candles, things like that. Yeah, I think this video is getting longer, so I would like to call it here for now, and I'll probably break some of these concepts down into their own specific videos as time allows. But until then, you know, appreciate your time and tuning in until this late. I don't know how long it's been, probably closer to an hour talking about this, but hopefully that helps. If you have any questions, let me know. I'm going to put this in the classroom as usual. If you are new to this channel and you haven't checked out the Turtle Traders Club on School, feel free to check us out. The link is in the description. For the turtles out there in the classroom, I would recommend that you revisit these videos as often as possible as they're available, so that you can refine your understanding of some of these things, especially if you're newer to this stuff. If you're not, you know, good on you. But if you are new to it, I would recommend that you watch these things a couple times. But until then, sayonara.